Before we start solving illustrations in Unit 4, which is derivatives and embedded derivatives, I would like to have some basic discussion about derivatives, which will help us in solving illustrations later. So derivatives, as per Ind AS 109, it's defined to actually be any contract which satisfies three conditions. Any contract which satisfies three conditions will be regarded as a derivative as per Ind AS 109. Condition number one is the value of the contract should change in response to an underlying variable. All right, the value of any particular contract should change in response to an underlying variable. So there should be an underlying variable. As a result of the change in underlying variable, the value of the contract should actually keep changing. This is condition number one. Condition number two is there should be either no initial investment. There should be no initial investment, or the initial investment should be very little. It should be low or little. All right. So condition two is there should be either no initial investment, or the initial investment which is there should be very nil, or it should be very low. The third condition is the settlement of the transaction should happen at a future date. All right. The settlement of the transaction, you are entering into the contract today, but the transaction should be settled at a future date. All right. These are the three conditions which any contract, if it fulfills, then it will be regarded as a derivative as per Ind AS 109. Let's start writing. The first condition is there should be the changes in the contract, the change in the value of contract should be a function of an underlying. All right, it should be a function of an underlying variable. So when the underlying variable changes, then the value of the contract actually is supposed to change. The second condition is there should be either nil or low initial investment. All right, the initial investment should either be nil or it should be very low. What do we mean by initial investment? Basically, when we are entering into the contract, the amount of outflow that we have, the amount of investment that we are required to make at the time of entering into the contract. All right, the stress is on the word initial. When we are entering into the contract, the amount of outflow should either be zero or it should be very low. And the third condition is it should be settled on a future date. All right, it should be settled on a future date. Now, these three conditions, if any contract satisfies, then that contract will be regarded as a derivative contract. Now, there are three most commonly referred derivative contracts. Throughout the curriculum, we'll see that there are three types of derivative contracts that are commonly referred to. Let's actually understand a little more about those derivative contracts. All right, so we are going to actually discuss about three common types of derivative contracts. Obviously, there are a lot of other derivative contracts also, but we are actually now discussing the three most common types of derivative contract. The first one is forward contract. All right, the first one is forward contract. The second one is option contracts. And the third one is swap contracts. All right, swap or swap contracts. These are the three most common types of derivatives that we are actually going to see: forward, option, and swap. Now, within option also, we may have two types of contracts. We may have two types of option contracts. The first one is we may have a call option, or we may actually have a put option. So there are three most commonly used derivative contracts throughout the curriculum. The first one is forward, the second one is option, and the third one is swap contracts. Within the swap contracts also, our primary focus will be on interest rate swap or IRS. All right, interest rate swap or IRS. So within option contracts, we then have call option and we have put option. All right. So within an option, we can have either call or with a put option. Now, I am actually not going to spend time to try and explain what each of these contracts actually mean. I'm not going to tell you what a forward option or a swap contract is. Instead, I will be spending time to show you how a forward option and a swap contract satisfies the definition of derivative as per Ind AS 109. I'm going to tell you how each of these three contracts will satisfy the definition of derivative as per Ind AS 109. Let's come to forward contract. All right. A forward contract is basically a contract where I am agreeing to purchase or sell. All right. It can be a contract to buy or sell shares at a future point in time at a particular price. All right, it can be either shares or it can be currency or any other underlying. All right, so a forward contract is basically an agreement to buy certain number of shares or certain amount of currency at a future point in time at a price which is decided today. All right, so the example of a forward contract is, let us say I agree to buy RIL shares after a period of 3 months, RIL shares after a period of 3 months at a price of 1800. Now, this 1800 is decided today itself. All right, I'm entering into the transaction today where I'm stating that I will buy RIL shares after a period of 3 months at 1800. Now, this is basically an example of a forward contract. This is an example of a forward contract where I have actually taken a buy position. I have bought forwards. I have actually purchased forwards. Same way, there can also be a sell forward contract where I am going to agree to sell for Reliance shares after a period of 3 months for an amount of 1800. All right, so there can be a buy position or there can be a sell position in a forward contract. All right, so within the forward contract, you can either have a buy position or you can have a sell position as well. In case you're actually having a buy position, you're agreeing to buy shares or buy dollars or euro at a future point. In case you're actually having a sell position, you're agreeing to sell shares or sell euros or sell dollars at a future point in time. All right, the price is decided today itself. All right, so in this case, in my example, I have taken a buy position on a forward contract. Now, when we actually enter into a forward contract, there is no amount of payment that is made upfront. Initial investment is actually not required to be made. There is a zero initial investment. All right. There is a zero initial investment, and settlement clearly you're able to see is going to take place after 3 months. What will happen after 3 months? After 3 months, I will receive Reliance shares and I will actually pay rupees 1800. All right. So the settlement of this transaction will take place after 3 months. All right. So the condition 2 and condition 3, you should be able to see clearly that I'm actually satisfying it. Conditions 2 and 3 are getting satisfied because the initial investment and forward contract is zero and it's also being settled on a future date. Let's actually see how is the condition for one being satisfied. Now, if you think of it, let us say the spot price of Reliance share, the current market price of Reliance share, hypothetically, let us say is actually equal to 1750. Let's say the current market price is equal to 1750. Now, if the share price goes up from 1750 in the next 3 months, let us say it goes up to 1900. All right, if in the next 3 months the share price actually goes up to 1900, if you think of it, I am actually sitting on a gain because I have the ability to buy the share after 3 months at 1800, whereas the market price of the share in after 3 months is 1900. All right, so after 3 months, the actual market price is 1900, but I have already entered into a contract where I have the ability to purchase the Reliance shares at a price of 1800. All right, so I am actually sitting on a gain. I'm sitting on a gain when the share price actually goes up. Same way, let us say if the share price falls down to 1600, if the share price, let us say, falls down to 1600, I am actually going to be at a loss because the market price of Reliance shares after 3 months is 1600, whereas I have entered into a contract to purchase it at 1800. I am actually going to pay 1800 to get Reliance shares under the forward contract, whereas in the market, it's actually available at 1600. Therefore, I am actually at a loss. All right. So when the share price goes up, I'm actually at a gain. When the share price falls, I'm actually at a loss. All right. When the share price falls, I'm at a loss. So clearly, if you notice the value of this forward contract, all right, my gain or loss in the forward contract or the value of the forward contract is changing in response to a change in underlying variable. All right. When the underlying variable, which is the share price in this case, changes, then my gain or loss on the forward contract is actually changing. All right. So condition number 1 is also satisfied because the value of the forward contract is changing based on the changes in underlying share price. My gain or loss on the forward contract is a function of the changes in the value of the underlying share price. Underlying is over here Reliance shares. All right. So condition number 1 is also satisfied. All right. Condition number 1 also is satisfied. Therefore, forward contract is going to be a derivative contract as per Ind AS 109. Forward contract is going to be a derivative contract as per Ind AS 109. Now, a point to note in this case is at the time I entered into the contract today, when I entered into the contract today, there is actually no cash outflow or cash inflow. Therefore, there will actually be no journal entry on the date on which I enter into the contract. All right. There'll be no journal entry on the date on which I enter into the contract because there is no cash inflow or cash outflow. There is literally nothing that is there to record itself, and hence we won't record any journal entry. The journal entry will only be directly recorded at the time of settlement. The journal entry will be recorded directly at the time of settlement. Let us see what those journal entries actually are. Now over here, I actually took two scenarios. Scenario number one was I took two scenarios. Scenario one is where the market price after 3 months is equal to rupees 1900. All right, let's say the market price after 3 months is actually equal to 1900. In this case, I am actually sitting on a gain. Why am I sitting on a gain? Because after 3 months, I have to actually purchase the share by paying only 1800, whereas I will be getting a share which is worth 1900. I am going to pay 1800 under this forward contract, but I'm going to receive a share which is worth 1900. Now, if you think of it, this is a benefit for you. This is a benefit for you. You have the ability under the forward contract to buy the share at 1800 while its market price is actually 1900. So this is a benefit for you. Now, let us actually look at the definition of financial asset. I'm going to unit one definition of financial asset. A financial asset is any asset where there is a contractual right to exchange financial assets with another entity under conditions that are potentially favorable to the entity. What is the saying? Any contractual right where I can actually exchange financial assets with another entity under conditions which are favorable to me. Over here, if you actually apply this definition to the current scenario we have, I am actually under a favorable condition because I am paying 1800, but I'm receiving a share which is worth 1900. All right. So I am actually having a right to receive a financial asset. Remember, equity investment in equity shares of Reliance is basically a financial asset for me. So I have a right to receive financial asset. Exchange financial asset is nothing but receiving financial asset with another entity. Obviously, I would have entered a forward contract with somebody else. So I am having the right to receive this Reliance shares from someone else under conditions that are favorable for me. That are favorable for me because I only have to pay 1800, but I'm receiving an asset which is worth 1900. All right. So this particular contract is basically a financial asset for me where the market price is greater than the forward price. Let us say where the market price is greater than the forward price, then this is basically going to be a financial asset for me. It's going to be a financial asset for me. And therefore, we are going to record an entry which is derivative financial asset debit. I am going to create an financial asset in my books of 100 rupees. I'm going to create a financial asset of 100 rupees and I credit P&L by 100. All right, this is a gain that I've actually made. I have the ability to purchase a share for 1800 only, whereas its worth is actually equal to 1900. Therefore, I am going to create a financial asset of 100 in my books with a corresponding credit to P&L. Now, after this, I am actually going to settle the forward contract. All right, this was journal entry A. I am also going to settle the forward contract. What does settling the forward contract mean? I'm actually going to receive the Reliance shares of 1900 and I'm actually going to pay cash of 1800. The journal entry for that will be I will debit investment in Reliance equity shares. I will debit it at 1900. Although I'm going to pay only 100, pay only 1800 for the purpose of buying these shares, I will debit investment in Reliance shares at its fair value. I will be debiting it at its fair value. Fair value is nothing but the market price of 1900. I credit cash by 1800. I credit cash by 1800 and then I reverse out the derivative financial asset. I reverse out the derivative financial asset of 100 rupees. All right. So this is how we are going to actually record the journal entry. All right. So on maturity, I first will create a derivative financial asset because a derivative derivative under which I have a right to receive a financial asset under favorable conditions is actually a financial asset. A contract where I have a right to receive Reliance shares under favorable conditions is actually a financial asset for me. It's a derivative financial asset, and hence I'm going to create a derivative financial asset of 100 rupees. And then comes the settlement leg where I actually receive investment in Reliance shares. I record the investment in Reliance shares at its fair value, and I credit cash and I credit derivative financial asset. All right, so this is how we're actually going to record the journal entry. Now let us say under scenario 2, where the market price was actually equal to rupees 1600. Let's say the market price was equal to 1600. Over here, actually, I'm at a loss because I am going to receive one share of Reliance worth which is 1600 by paying rupees 1800. And if we look at the definition of financial liability, it states that a financial liability is any contractual obligation to exchange financial asset with another entity under conditions that are potentially unfavorable to the entity. Now, over here, if you look at it, I have an obligation to pay 1800 and I'm only going to receive an investment which is worth 1600. So, this is an obligation for me to actually receive a financial asset under unfavorable conditions. It's an obligation for me to receive or purchase a financial asset under unfavorable conditions. Therefore, I will record a derivative financial liability. I will record a financial liability in the books of accounts by passing a journal entry which would be P&L debit of 200 and I credit derivative financial liability. I'm crediting derivative financial liability of 200. All right, how did I calculate the 200? The 200 is basically the difference between the forward price and the current market price. All right, so this is the difference. In case the forward price is greater than the current market price, it is actually a loss. All right, if the forward price is greater than the current market price, it is actually a loss. If the forward price is less than the current market price, it's actually a gain. All right, so I record a derivative financial liability. This is the journal entry A, and I have another journal entry wherein I will actually debit investment in Reliance shares. I will debit investment in Reliance shares when I'm actually receiving the Reliance shares. Although I paid 1800 for the share, I am only going to debit it by 1600, which is the fair value of the shares. Then I debit the derivative financial liability. I'm going to debit the derivative financial liability by 200 and I will credit cash by 1800 rupees. All right, so this is how we will record the journal entry in case of a forward contract where we are actually settling it at a loss. All right, where we are actually settling it at a loss, this is how we're going to record the journal. Now, you may know that a lot of times in case of forward contract, a physical settlement may actually not take place, which means on the maturity date, I need not necessarily purchase a Reliance share. They may be net settled in cash. They could be settled net in cash. In such a case, what would happen is I would be basically just paying 200 to the counterparty. I'm only going to pay 200 to the counterparty. So the journal entry for that will be derivative financial liability debit to cash of 200. All right, I only have to pay 200 to the counterparty. So the journal entry will be simple, which is derivative financial liability debit to cash. All right, where we are doing a direct cash settlement instead of a physical settlement, it will be derivative financial liability debit of 200 to cash of 200. All right, in the previous illustration, it would have been bank account debit to derivative financial asset of 100 rupees. All right, so this is the accounting for a forward contract in case of physical settlement and in case of net cash settlement. All right, this is in net cash settlement. Now, in this case, what I've actually told you is there is going to be no journal entry on the date on which we enter into the forward contract. On the date on which we enter into the forward contract, there's going to be no journal entry, but directly we saw the journal entries on the settlement date itself. But what if there is actually a balance sheet date between the date on which we are entering the contract and the date of settlement. What if I have entered into the contract on the 1st of March and the contract is going to settle 3 months later? And in between, I have to actually prepare my balance sheet on the 31st of March. Will there be any journal entry on 31st of March that I'm actually required to pass? Is the question. The answer is yes. On each balance sheet date, derivatives are required to be reflected on the balance sheet at their fair value. Derivatives are required to be reflected on the balance sheet at their fair value. Now, what does that mean? Fair valuation is a separate task in itself. I'm not going to tell you how fair value is computed, but what I would tell is, let us say we have entered into the contract on 1st of March. If the share price increases for between 1st of March to 31st of March, if the share price increases from 1st of March to 31st of March, then the forward contract will have a positive fair value because you're sitting on a gain. If the price actually increases, you're actually going to gain, but that gain is not certain because you do not know how the share price will move in the next 2 months. All right, but so far, based on the share price movement in the current month, you're actually sitting on a gain. Therefore, that will be reflected as a positive fair value. You will actually have a fair value, positive fair value, and you will actually classify that as a financial asset on your balance sheet. All right. If your derivative has got a positive fair value, you will be classifying it as a financial asset on the balance sheet. Same way, opposite, if let us say the share price has fallen from 1st of March to 31st of March, you will actually be sitting at a loss and your derivative contract will actually have a negative fair value, which you will actually show as a financial liability. Negative fair value will be classified as a financial liability. All right. So just like over here, what we did is we directly reached at the end of third month and we said that at the end of third month, when market price is 1900, then I have a gain of 100 rupees. All right. And I actually created a financial asset worth 100. Alternatively, I created a financial liability worth 200. I'm actually asking you to do the same thing. The only difference is instead of on the settlement date, you are now on the balance sheet date. On the balance sheet date, you are required to calculate the fair value of the derivative contract. If you are actually having a gain, it means that the fair value is positive and you actually record a derivative financial asset. If the share price has actually fallen, then the fair value is going to be negative and therefore you will record a derivative financial liability. All right. So on every balance sheet date, you are required to recognize either a derivative financial asset or a derivative financial liability based on how the underlying variable has moved in that particular period. Correspondingly, any gain or loss will be taken to the P&L account. All right. So derivatives are going to be measured at fair value where the gains are going to be recognized in P&L. Gains or losses will be recognized in P&L. Therefore, derivative is regarded as a financial asset, which is financial asset or a financial liability, which is measured at fair value through P&L. All right. So derivatives are always measured at fair value through P&L, which means that gains or losses are going to be taken in P&L account. All right.